Welcome to Trader TV Fixed Income, your insight into the trading climate for professional bond investors. I'm Dan Barnes. In July's show, we'll be taking stock of the conditions in the corporate bond market with Edward Casey, an independent portfolio manager. We will look at the dynamics which might affect fixed income investors in the second half of 2018, and then how that might affect their interaction with their trading teams. Monthly government bond data is supplied by MTS. Edward, welcome to Trader TV.
Thank you, Dan. Nice to be here.
So my first question is, how would you characterise investment conditions in the first half of 2018 in credit?
I think for credit and all financial assets, it was really a return to volatility in the market. So, we had several challenges facing overall markets here in the United States. We had interest rate policy moving up. We had some dislocations in February around some of the ETFs having a tough time. And of course, we had the central bank reversing and unwinding some of their balance sheet. I think one of the dynamics that did take place in the first half that was a challenge was the correlation of returns. I think as you think to February, we had an environment where both equities and credit and fixed income in general, all the returns were negative. Historically, credit returns and fixed income returns are negatively correlated to equities. But if you look back over a much longer time period, you can see that there's moments in time where they have been positively correlated. So I think for portfolio managers and traders, today they're looking at their portfolios and really trying to structure how they're positioning, whether it's deploying, say, for example, credit default swaps or other kind of tail hedges to make sure that they create a anchor to windward for their clients that their portfolio will return positive returns in tougher times.
And then looking at the second half of 2018, what do you think are going to be the big dynamics impacting the market?
I think for the second half, probably the biggest dynamic is just the removal of central bank accommodation. When you look at the balance sheets of the largest 6 central banks in the world over a longer time period. Again, looking back over the last 10 years, they've expanded by over $14 trillion. And although here in the United States, we turned off the printing presses in late 2014, the other central banks have continued to be accommodative, providing liquidity to the market, and they've added about $5 trillion of debt to their balance sheets. And one of the things that's very important to think about is as you track, and if you were to look at the market cap of the equity indices versus these central banks' balance sheet expansion, it's highly correlated. So I think for the second half of the year, here in the United States, starting this month, the Federal Reserve will be removing $50 billion per month off of their balance sheet. That annualizes to $600 billion. And I think for your viewers to remember is, as recently as 2002, $600 billion was the entire balance sheet of the Federal Reserve. So, we do have an environment where the Fed is trying to raise rates, trying to more normalize their balance sheet. I think this does risk slowing some of the growth here in the United States. And that will be at a time where the boost that we're getting from the fiscal and tax policies will be wearing off. So I think that will continue to be the largest challenge as we look at the second half of the year.
Which investment themes do you expect to develop? Well,
I think one of the things to think about is just, we are now in the second longest expansion here in the United States. And, that we're a year away from being the longest since 1857. So I think, having a understanding that, good times won't last forever, I think is very important. As credit portfolio managers look to make investments today in bonds that are 5 years out, I think their analysis really needs to include the potential that these issuers could be in a more difficult time when these bonds are coming due. So I think you just have to include that. I think the other theme that will be very important here in the second half of the year will just be a renewed focus on liquidity. I think as you think about just the overall trading liquidity in corporate bond markets, the broker-dealer community out here, the Federal Reserve tracks their positions on their balance sheet. Before the great financial crisis, they were positioning about $300 billion of debt on their balance sheet. Today, that has shrunk down to $20 billion for many reasons, including regulatory reasons. Versus that, we've seen the corporate bond market here in the United States, whether it's investment grade and high yield, expand from about $3.5 trillion to now $7 trillion. So you have $7 trillion market that's having liquidity provided to them of about $20 billion. So I think that will very much change the dynamic as we get into which I expect, a market with more volatility, higher yields. I think we're going to see traders and portfolio managers really focus on liquidity in their portfolios and how they can create it.
Which dynamics do you think are going to be most challenging for trading desks to deal with, such as managing liquidity or price formation?
As we see volatility return to the markets and correlations break down, you will expect that those desks, whether again the sell-side trading desks, will be forced to de-risk some of their portfolios. So I think that is important. I think when you look at the bid-ask spreads that are in the market, what Market Access, which is one of the electronic corporate bond trading platforms, has some great data on historical bid-ask spreads. And what we do know is volatility returns to the market, both the cost of transaction, that is where you can buy versus where you sell, and the amount of volume that you can execute at that level. Certainly today, that cost is very small versus historic. So I think for traders to be aware of that in more difficult times, the bid-ask spreads can widen out, and that can certainly influence positioning. The environment today it warrants a more cautious outlook on credit. So I think for traders can really be beneficial for portfolio managers is that discovery of liquidity, being able to reflect back to the portfolio managers where they're seeing opportunities in the market. And so those opportunities today have really been geared around positioning in short duration bonds with the pull to par. But I think, as these dislocations can take place in the market, they really need to be viewed as opportunities. And I think that is where in the corporate trading world, traders are a huge help to the portfolio managers being able to really show them where there are opportunities. So I think, liquidity will be key. I think as you look to position portfolios going forward, it's okay to under yield a little bit to have that liquidity and cash available to take advantage of these opportunities. So I really think, as you think about the potential for credit, credit returns are very asymmetric in how they're structured. The upside is quite limited. The downside can be quite significant. So I think today we're in an environment, to use the analogy of gardening, where really portfolio managers and traders should be looking at their portfolios. They should really be pulling the weeds and watering the flowers and having the liquidity and cash available to really take advantage of dislocations that can happen in the market.
That's been great. Edward, thank you very much for coming on Trader TV.
Thank you so much, Dan.
I'd like to thank Edward Casey for his insights into the market for 2018, MTS for providing our government bond data, and of course you for watching. To catch our monthly reports on other markets or to subscribe to our newsletter, go to tradertv.net.